Hey Internet, it's RJ. Welcome back. Thanks for tuning into the show today. Now today is Sunday, so you know what that means. We're going around the net with all the news you can use in the week that was in credit and finance. So on the docket for today, of course, we will talk about the major story at hand, Silicon Valley Bank, the fallout, how this could potentially spread to other banks, and more importantly, how our very own Jamie Dimon saved the day once again. Of course, we will have some of our regular stories as well. The Chase Q2 categories are out, and a new Chase trademark for a potential Chase Freedom card coming to the market that we will overreact to. So of course, that sounds interesting to you, then go ahead, press the subscribe button, and let's get to work. Now, when it comes to it, again, I could have probably made a full video about Silicon Valley Bank, but, you know, I'd rather spare everyone the thumbnail with the fire and everyone freaking out, you know, the freaked out face. So I'll also link to a few videos from Cold Fusion and the Plain Bagel that I've watched that go into much more detail than we're going to go, but I was asked about this. I think it's interesting, so we'll spend quite a bit of time up front talking about this, of course, because the story at the end, well, not for Silicon Valley Bank, but for the banking industry, has a cameo by everyone's favorite banker, Jamie Dimon, saving the day. So here we go. Again, chapters tool down below if you want to skip around. Our regular stories will be at the back end here. So Silicon Valley Bank, in case you're unaware, they're actually not a new bank. You know, a lot of folks are just hearing this name for the first time, SVB for short. They go back all the way to about 1980s, and as the name would suggest, they are focused on, you know, a certain type of client, that being startup companies. Now, granted, they do have more mature companies that, you know, bank with them, who have grown up with them, so to speak. But that's kind of the niche that they focus on, right? And a lot of these startups, companies, and founders, they potentially run into issues finding a regular banking partner because banks historically, especially the big ones, don't care for risk because they make a ton of money on their own doing other things in wealth management globally, things like that. So they don't really necessarily need to focus on this niche because if you look at startups, you know, it's a lot of convincing someone that, hey, I'm going to build this thing and it's going to do a thing and it's going to be really cool. Then, you know, old school banks, well, how are you going to generate any money? What are you going to sell, right? So it gets hard, right? Because a lot of these startups are fueled more so by venture capital than anything else, or VC money. But you still need a place to bank. So that's kind of who they focus on. So if you fast forward all the way to, I don't know, maybe 2020, 2021, money is very cheap. And so VCs, investment companies, you name it, hedge funds are giving tons of money to these startups. We're going to use the term startup. They're not all startups, as we mentioned, but we're giving money to these types of companies. And, you know, because money is flowing, these companies don't necessarily need all that cash. You go put it in the bank, and your bank of choice is probably SVB, which is fine. So SVB sees, you know, a large rise in deposits on the assets under management side. And like they do what any bank does, and say, well, we shouldn't just leave this here. We should do something with it, right? So they go and they buy bonds. I think they were based on like mortgage-backed securities, which basically function as bonds because there's an interest rate. You buy it, and then, you know, if you hold it to maturity, it's going to continue to pay you out that interest rate. Bonds generally kind of like a safer investment type deal. So they hold those, and even on their balance sheet, it says they were going to hold those till maturity, which again means you're not really planning on trading these bonds. You're just going to hold on to them, we're just going to say 2% continue to pay you until, you know, you're made whole again on your investment. So, again, nothing wrong with that, but these bonds are, you know, written at 1-2%, something like that, because at the time, you know, interest rates were down, so the bond market is what it is, and slowly as the free money starts to dry up, interest rates start to grow, get higher, you know, a lot of their clients, their startups, you know, they start to need more money to run day-to-day operations. They're not just getting cash infusions from VCs like they used to all the time, right? So you come to SVB to pull out some of your money, and well, SVB's like, okay, well, you know, we still owe you the money, we're going to get it to you, but we've tied up quite a bit of it in these bonds, and unfortunately, you know, as the bond market does, newer bonds written, you know, later around this time, or, you know, maybe 3, 4, 5, 6% rate, because interest rates have gone up significantly, right? So the bonds that they have are no longer, they're still worth something. Again, if you hold them to maturity, they will continue to pay you out, and you won't lose money if you hold it. You do end up losing money if you have to sell them, because again, if I can buy a bond at 5, 6, 7%, I mean, I'll buy your 2% bond, but it's going to be at a bargain price discount, obviously, because I can do better elsewhere in the bond market. But if they have to sell some of these assets to free up capital to meet their obligations, and they do, right, because nothing legal is going on here at the moment, at least, so they do. And I believe, you know, somewhere along the line, word gets out that, hey, they're sitting on these assets that aren't really potentially worth as much. They have a cash crunch. I think SVB management says, hey, we're going to go on a cap raise, which is a way the bank can just literally raise capital to meet their obligations. That spooks people more. Everyone shows up trying to withdraw all of their money. I think they lost a quarter of their deposits within a day, giving them actually like a negative cash balance, right? Which you have every right to do. It's called a run on the bank, which is kind of ironic because that's the name of the second channel, run on the bank. So, regulators step in and the FDIC steps in. They take over they take over SVB. They close it on a Friday, then it reopens on Monday, and then folks can get their money out. Now, what was a little bit interesting here was that, the FDIC rules, deposits insured up to $250K per account, like you're good to go no matter what. But this is basically a commercial bank. So I know the public laughs a lot, like, oh my gosh, why would you have so much money in the bank in one account? But this is basically a commercial bank. Like, you or I can't just go get accounts at SVB, right? So the FDIC said, hey, look, we're going to make everyone good. Don't worry about it. We'll insure everything, every deposit. And I think 97% of their money on deposit was over that FDIC threshold, right? So there's that. The bank is up for sale. It's closed, and it's kind of like in a weird limbo state where they definitely took control of it. It's kind of like they move everything to like a holding account again so it can resume operations and you can get your money out, but it's not really like open, if that makes sense. So over in the UK, I believe HSBC bought that arm of it for $1, but it's kind of misleading because they're going to have to still step in and, honor all those obligations. So it'll be more than $1 by the time they're all done with it and what they'll owe. So there's that. Now, what we don't know so far, because again, that could be fine, what happened. And it could just be like just mismanagement. You did a bad job. You should have had an eye on the bond markets and understand what's on your balance sheets, right? I know they didn't have a chief risk officer for a while. That's kind of an excuse, honestly. It's just a public name that you can blame. You should have a risk management department, I would imagine. So now the question comes up is, did they know, or was it poor management? Because if you look into it a little bit further, saying, hey, we had, the officers of the company, they had sold a bunch of shares a few weeks before. Of course, the company says, well, this was planned. Was it? I don't know, maybe. I mean, these things do have to be planned and disclosed. Could be coincidence. You go a little bit further. They also cut checks to the U.S. employees like hours before the bank was taken over by the regulators. Comp time for banks is in March, but it doesn't really look good. So now the investigations will happen. We'll figure out, did they know this was going to happen and do nothing and try to cover themselves, or were they just totally bad at their jobs? I don't know if each one is really better or not, but that's kind of where we're at with SVB. Now, if you look at where does Mr. Dimon come in, our hero of the story, well, now everyone's kind of concerned about, they call it this contagion. It's always interesting to see the word that we pick in these stories, right? So this contagion spreading to other banks. And really what they mean by that is, will there be other runs on the bank, on other banks, right? There are some regional banks, Republic Bank is the biggest one by name that's caught up in this, who have similar asset scenarios like SVB does. And then I still think this is partly the media's fault, but, because the normal person isn't going to know this, what's on their balance sheet, but then they dig it up, who's got exposure. First Republic's become the poster child of this, although Bank of America is the largest one with a similar situation, except Bank of America is massive, second largest bank in the country, so we're not as worried about them, really, but, they're a big name, so they get headlines, right? So people go to, First Republic and start pulling out their money as well, not wanting to even be tied up in a bank shutdown. Granted, being closed on a Friday and open on a Monday is a pretty quick turnaround, considering you couldn't get any money out Sunday, and Saturday would only be a half day. So, I mean, really, the FDIC and the feds actually did a really quick turnaround, a really good job, which is rare to say about a government doing anything. So where we're at now is that, you have First Republic Bank, and what gets really interesting here, because this is from CNN, because, the government really didn't want to do a bailout per se. So what happened here, CNN was reporting, is that Janet Yellen, the Fed chair, organizes a private meeting with our hero, Mr. Jamie Dimon, the CEO of JP Morgan Chase. She goes to Mr. Dimon, and they basically come up with a plan, if you will. So Dimon goes to 11 other banks, and the banks end up raising about $30 billion to put into First Republic Bank to help stabilize it. Now, overall, this plan is supposed to show that, hey, banks have confidence in the banking market, number one, and then from the other side, Yellen goes and kind of handles, like, the policy type stuff like that, at least on the government end. So they kind of work together to do this, and then First Republic, of course, they get the infusion. It's basically like, it's not just giving them the money, but they come up together and kind of save it, so to speak. So it's not really a bailout, but it kind of is, because there's also a government component where the government will basically loan money, or not the government, the Federal Reserve will basically loan money to these banks and use the assets on their balance sheet as collateral for 1 year. Now, again, back to the beginning of the story, because these assets, and I'm not speaking for all of them, but the assets we're talking about are bonds, they have, like, a low risk of failing. At least I didn't see a list of the bonds, but this is what the Fed is saying. They have a low risk of failing, so we'll take those as collateral, so we don't believe that these banks are going to default, and it's not really a loan, because we have collateral on them, and we could hold these assets until maturity, which is what some of them plan to do. So overall, I think everything's fine, as fine as it's going to get. I think a lot of this was that contagion was a little bit panic when you get people who don't really know what's going on, but you have every right to take your money and move it where you want to protect yourself. I totally get that. I think it was interesting that, Yellen goes to Mr. Dimon first. Out of all the banks in the country, you go to Jamie Dimon first, one-on-one, say, hey, can you go get these other 11 banks in order to help us out and basically raise $30 billion, which is not an insignificant amount of money, even though there are 11 banks. The other big issue is, again, from just Silicon Valley Bank alone failing, most individual people aren't affected, because most people didn't know SVB was a thing until the news happened, right? So not to make light of it, but the real issue is, like, there seems to be a potential void of financial banking left in Silicon Valley for these founding companies, these startups and things like that. And again, matured companies as well. They'll probably get bought, but whoever steps in and buys them, will they really want to assume that level of risk? Because there was nothing stopping massive banks from doing what SVB has been doing since the 80s. They've just chosen not to. So that's, that could be the potential fall off there. And of course, again, we have other banks with, trying to combat their own runs. For us, I think I'll say this, I think it is a bit interesting because, now there's a lot of free money up for grabs for banks. So keep your eye on banking promotions, honestly. Banking promotions have been a little bit quiet this year, and it might be a little rude to say, but we may be able to cash in on some of this because there's a lot of people who have shaken confidence in some of their banks. And again, not to be rude, people with shaken confidence don't generally know why their confidence is shaken. The news had a lady on, they were interviewing. She's like, I'm leaving First Republic Bank and going to Bank of America so my money is safe. Like, not 3 weeks ago, we talked about Bank of America having issues with Zelle, and so your Zelle payments were missing, and when you showed up to the branch to ask about it, they told you to go away. So, I mean, not to make fun of anyone, but I mean, yeah, it happens, but come on. It's not the best example, I guess, is my point. So I would keep my eye out for banking promotions and things like that, because why not? Recessions are garage sales for the prepared, I guess. I'll leave it at that. So Jamie Dimon, our hero, I found that pretty interesting overall. So that is the story where we're at so far. Again, that was the high-level version of it, in case you want to know what's happening. If you found this almost 11-minute segment on one topic interesting, then we will continue to follow this story and report back on it. But we do have other topics to get to that are more in our wheelhouse. Both Mr. Dimon and the Fed pulling double duty this week, as our first story is about Federal Reserve. Now, the Federal Reserve is launching a product, a payment transfer system, basically called FedNow. The idea of this is you'll be able to send money instantly from anything, from bank to bank, customer to business, business to business, you name it. And it should settle in a matter of seconds, which is on some level not that much different than Zelle. So I kind of don't get where they're going from. It sounds cool, but it's set to roll out in July, so they're getting ready to, do some pilots and onboard some banks, get it tested. They have a number of banks. They didn't say who specifically. I'm lined up, as well as processors as well. Now, overall, again, to me, this just sounds like a Zelle competitor, really. If we were talking about replacing ACH and making ACH instant, I think we'd have something. Granted, some banks can do ACHs instantly. I just did one from Chase to Citizens the other day for like $5 for a bank bonus requirement, and that's a game changer. So I don't know what benefits they're going to be of using this one versus, Zelle. I think Jeremy, who sent the story in, said it's probably just another way for the government to know exactly what you're doing with your money, which is, a less than zero chance that is actually true. Additionally, if this is geared toward customer to business and there's yet another way that you can pay merchants who already don't want to take credit card payments, then I do wonder if, this will be another thing that merchants try to push you towards over using a credit card. We're early on it still, we'll have to see, but it is fun and interesting that now they're coming to the party later when we already have Zelle and a few others that allow you to transfer money quickly. Now, the other two Chase stories, Mr. Diamond didn't get a lot of rest this week, but that's okay. That's why he's the people's champ. The Q2 categories for Chase, you're going to have Amazon and Lowe's this time around. Those are going to be your 5X categories. Overall, I think they're fine. Amazon's pretty good. Lowe's, yeah, it would have been nice if it was home improvement stores and not just Lowe's, but I'll take it. I think it's fine, and better yet, they don't overlap with Discover, which is restaurants and wholesale clubs, so I don't really think we need much time there to build out a strategy, because Amazon sells everything. They sell gift cards to other stores. Lowe's sells gift cards as well if you don't need a hammer or a saw or something, I guess. So just remember, you do have to activate them on every single card that you have, and you'll be good to go starting in Q2, which starts in a few weeks. Now, the last Chase story is probably the most interesting one and probably would have been our lead story, our anchor story, if the banking world hadn't tried to fall apart. So Chase filed a trademark for a potential new credit card called Freedom Rise. Now, there's not really anything in the trademark document other than the name and the kind of business it's in, so we're going to assume it is a credit card. Now, we know nothing about this, but that's not going to stop us from over speculating. I'm going to be a killjoy with this one. I've seen it. I could see it going two different ways. As many people have speculated, it's probably going to be a card aimed at, building credit, right? Rising your credit, if you will, rising your credit score. That would make a lot of sense. They have the Slate Edge. They just rebranded the Slate Edge maybe 2 years ago, but technically all the personal cards are Freedom, Student, Flex, Unlimited, so it would make sense to simply just roll it in and have it Freedom here and the Sapphire here. It would make sense for continuity's sake, ease of use, or, if it was going to be a good card, I don't think it'll be another no annual fee. Here's another 5X. I think it could potentially be akin to like the U.S. Bank Shoppers Cash Rewards card, where you pay an annual fee, but you get 6% back in a few categories, which is capped. But if I'm Chase, I don't really see a need to be ultra competitive and make another card to give you even more ultimate reward points. As we've said, before, Chase does tend to hide from your mainstream categories like groceries and gas and things like that. But, who are they competing against? There's American Express. American Express and Chase are doing two totally different things. They're just both the best in the game, so I don't even necessarily know. They're kind of competing against each other because they're in the same space, but if we're all honest with ourselves, one system usually suits us better than the other. So I really, I'd love for it to be a custom cash, in Chase land, but I don't really see a need. So for that reason, I think it's going to be, it would be something like either a credit builder card, which Chase has historically ignored that part of the segment before, customer base. They don't really like dealing with subprime type stuff, but you get to a certain point where, you only have one area left of the population because you've ignored it. It's kind of like the inverse of Capital One, where Capital One kind of ignored everyone for so long over here, going after new credit, student, subprime, and now you got to come out with a Venture X because we've outgrown our customer base. So it could be that in reverse. But if they put a decent sign-up bonus on it, then I guess for 1 year, whatever, it could still be interesting. So that is what we're doing with the trademark. We will, of course, keep an eye on it, because when Chase releases a new card, we have to drop everything and run out and get it, or complain about 524. So let me know what you think that card is down below, but that has been the news in this longer version. So, of course, if you liked it, drop me a thumbs up down below. If you found it particularly interesting, consider subscribing to the channel, because we're posting content just like this every week. Right back here every Sunday with all the news you can use in the week that was in credit and finance, of course, every single day over on ProfitableContent.com. Again, question for you: thoughts on the opening long segment on SVB and the bank deal? Again, more high level, but if you liked it, we can keep an eye on it. And of course, let me know what you hope the Chase card is going to be, as well as what you really think it's going to be. And of course, what else is going on in the news? Of course, there's Credit Suisse, but that's a topic for next week, I suppose. Anyways, guys, that's going to do it for this one. As always, thank you so much for watching. I'll talk to you very soon in the next one.